If you're a medical professional curious about what hidden dangers might be in store for your retirement, you're going to want to stay tuned to this week's episode. For those of you that have been to London, you're probably familiar with the phrase mind the gap. It's throughout the London subway system, and it's the gap between the platform and getting on the train, or don't get caught in the gap or the hole when you get on the train. So today we're talking about the same idea applied to your financial future. Is there a gap between what you want your lifestyle to be and how you're building it for now? So let's get started. So let's start with a question. Would you rather be rich or know that you're never going to run out of money? So I used to make dinner presentations for doctors before the pandemic, and I would start with this question. So which would you rather have? This is tied to our subject today of the retirement income gap. So retirement should be the time to finally relax and enjoy life after all of your years of hard work and service. But that vision can quickly fade if you don't address the retirement income gap. What is that? Well, it's the difference between the income you'll need in retirement and the income that you'll actually have. So the gap is all too real for many people. And a lot of people don't actually know that they've got a gap. But the good news is you can close it, right? If you start planning now. So in this episode, we'll break down what the retirement income gap is, how to identify it, and what steps you can take to bridge it. So from considering taxes and market risks to creating multiple income streams, you'll get a full picture of how to secure a comfortable, worry-free retirement. So let's dive in and explore how you can mind the gap before it's too late. So we've said the retirement income gap is the shortfall, negative number, between your retirement savings and the income you'll need to maintain your current lifestyle. So while it may seem simple, just build up a big pile of savings, it's actually more complicated than that. So you need to ensure those savings can generate enough income to cover your living expenses throughout your retirement years. And the average retirement is 22 years, assuming someone is retiring at age 65. So think about that. 65 plus 22 takes you to 87, which gets you to average life expectancy. And you know better than anyone that people are living longer. So the wonders of modern medicine, right? So the pile of savings versus the income streams. Well, having a large savings account is great, but that pile of money isn't going to last forever unless you turn it into steady income streams. So think of it this way. $1 million in savings might sound like a lot, but if you're relying solely on it and withdrawing money each month, it can shrink fast, especially if it isn't growing. So your savings is your safety net, but it's not meant to be spent so quickly. And what are income streams? Well, just like the income from your job right now, these are consistent sources of income such as Social Security, pensions, and investment returns. They can help you avoid burning through your savings too quickly. So I'm going to share a story with you. I recently was talking to a cardiologist that I've known for years. And based on a long working career, I always ask him, when are you going to retire? So there's usually some grumbling about this or that. Do I know Mr. X, his blah, blah, blah. And there's never any clear answer. So this conversation of ours has been going on for years. So it always makes me curious because why doesn't he know the answer? Why doesn't he know the answer? So in any case, after the grumbling, I said, well, you know it isn't about the big pile of money, don't you? So I've got his attention, right? I paused and I said, it's about the income streams. So he drops his pen and he said, you are right. So over the years, why isn't his advisor telling him exactly when he can retire? My guess is that he's working with an advisor that is working on the big pile of money approach, right? The big pile of money theory, and even harder to predict that when it's all in the market. So his advisor is making money on his money in the market off of the fees that are growing in the pile. Now, that's not what I do. I want you to know in advance, like now, what the income streams are so that you can see that your needs expenses like food, home, insurance, utilities, car, etc., are covered without ever having to think about it. Okay, if you're dealing with a big pile of money approach, you've got to figure it out every year when you're already in retirement. So let's think about that. We have to figure it out every year when we're already in retirement, unless the pile is so huge, you don't even have to think about it. But you know what? 99.9% of the people are not in that situation. So there's a theory out there, I'm going to do an episode around this, the 4% that, if you've got enough and you're taking out 4% and you're making 4%, doesn't quite work as easily as that sounds, but I'll make an episode for that. So for myself and my clients, I want a pension-like income stream every year to know that I can pay my bills for the rest of my life. And remember, I like getting from point A to B with the most efficient direct approach. And that's what I've done for myself, my friends, and my clients. Okay, so what's the first step? Well, the first step is to calculate your retirement income. How much income are you going to need in retirement? So a good starting point is to aim for about 80% of your current income. That's because while some costs may go down, no more commuting, others could rise. Think about healthcare, think about leisure, think about flat out fun. So that's what it's supposed to be about. So for example, if your household income is $200,000 a year, you'll want around $160,000 a year in retirement. So keep in mind, this is just a ballpark figure. I'm using this number for easy math. Your number may be higher, your number may be lower. So everyone's situation is different, and factors like debt, lifestyle, and health are going to affect your personal number. So don't forget about the taxes. So one big thing people forget about is taxes. Sure, it's possible that you could be in a lower tax bracket in retirement, especially if you're a high income earner right now, but there are no guarantees. So we have no idea what tax rates will be when we retire, and they could be higher than they are today. So many resources of retirement income are taxable. One day I had a medical professional tell me that his 401k wasn't going to be taxed because he wasn't working anymore. So I had to clear that up pretty quick. Okay. So traditional IRAs and 401ks, 403bs, keep in mind that the money that you're putting into these accounts is pre-tax. So pre-tax means you are deferring the income and the taxes and letting it grow or compound without taxes. So you say defer, I say postpone. So postponing the income, postponing the taxes. And most importantly, what you're postponing is a tax calculation, meaning what is the income bracket? What is the percent? Two different numbers, very important, okay? So you have no idea what the taxes are going to be when you retire and throughout your retirement. So withdrawals from these accounts are taxed as regular income. You postpone the income, so you'll want to factor that into your planning. Okay, so Roth IRAs, let's hit on that for a second. And with Roth IRAs, you're not going to owe taxes on withdrawals because you paid the taxes up front. This makes them a great hedge against future taxes. And while many of you you may make income that disqualifies you from participating in a Roth, there are some things that we can do to get you tax advantage, even tax-free income. So I have an episode on taxes that is a must-watch to get a better view of the tax picture and your retirement. It's likely that it doesn't look like you think it might. Check it out and it'll make you money and you'll be ahead of the game. So step 2, understand the risks to your savings. So even if you've calculated your income needs and think you're in good shape, there are a few major risks that can throw your plan off course. So here's what I think are the big 3. First one is market risk. Will your savings grow or shrink? Well, the stock market can be your best friend when it's going up, but if there's a downturn right when you start withdrawing your savings, it can take a serious toll. So if your portfolio loses 20% in value, but you're still taking out the same amount every month, you're going to run out of money faster than expected. Does that make sense? I've got a medical professional client that when they came to me was early in 2023. So they'd been saving their entire career. They'd done okay with investments. And in one foul swoop, their $2.5 million over their whole lifetime that they had and they'd accumulated was down $500,000, $500,000, one foul swoop to $2 million. And they'd started their retirement in 2022. So they'd started it right at that downturn. And the market, what a lot of people seem to forget is at the end of 2022, we lost 22% very fast. So they're freaking out. So what did they do? Well, we handled it. We fixed the problem so that it couldn't happen again. And we actually found some ways to get all that money back and a lot more. So the next one, tax risk, tax uncertainty. It's a moving target. As we mentioned earlier, tax rates are unpredictable. You might assume you'll be in a lower tax bracket, but there's no way to know for sure. So the government can change tax laws. And if you're relying on a taxable retirement account, an unexpected tax hike could drain your funds faster than you think. So when I say a taxable retirement account, I'm talking about your 401k, your 403b, your IRA, okay? All of those are taxable. They can change the taxes in the stroke of a pen in the government. So the third one here is longevity risk, right? Healthcare cost, you guys know that better than anybody. It's a big expense. So healthcare is one of the biggest unknowns in retirement. The cost can be staggering, and for most people, they underestimate them. A couple retiring today can expect to spend more than, now they're retiring today, they can expect to spend more than $300,000 on healthcare alone during retirement. That doesn't include long-term care, which could easily add tens of thousands, even hundreds of thousands to your bill. Okay. So what do we want to do? Well, step 3 is create multiple income streams to close the gap. So the best way to close your retirement income gap is to have multiple income streams. That way you're not relying solely on your savings and you can adjust more easily to unexpected expenses. Okay, so let me talk a little bit about a retirement income stream. An example that you would know, it'd be, let's say it's a policeman, a fireman, a teacher, and the fact that they've got a pension, right? So they work those careers for 30 years, 40 years, and maybe they love what they do, but part of the reason that they stay is knowing that they're going to have a pension that covers their bills. So when I talk about a multiple, income stream to close the gap, I'm talking about an income stream could be something like a pension. An income stream is also your Social Security. Okay, so we say pensions, annuities, different types of investments. So let's talk for a minute about Social Security. Key here is don't claim it too early. Okay, Social Security will likely be a big part of your retirement income, but be careful not to start claiming it too early. So you can actually start receiving the benefits at 62. Your monthly payout is going to be significantly reduced compared to waiting until the full retirement age, or even better, age 70. So full retirement age, when you look at your report, that says FRA, typically 66, 67, depending on what your age is. But when we go to age 70, that's going to maximize our benefits. And what you may not know is that each year that you wait to take your Social Security, you actually get an 8% raise. So think about that. In your job, are you getting an 8% raise year over year? All right. So there's a lot of people that are like, you know what? I earned it. I'm entitled to it. I'm going to take it as soon as I can at age 62. And my advice is you wake up at 62 shortly before and you say, am I healthy? Do I have any bad illnesses? Do I have to have the money? And if you don't have to have the money, then you wait, let it roll another year, make a decision, and you just got an 8% raise. So think about that. If you live a long life, costs are going up, doesn't it make sense to have the higher income if you can? So, okay, the next one here we talked about pensions, and we're going to talk about annuities. So annuities, same idea, is a steady income for life. So annuities can provide a steady income stream for your entire life, almost like creating your own personal pension. So you pay a lump sum up front, and in return, you get guaranteed payments for the rest of your life. And they'll structure that like saying, if you start taking this at age 67, if you start taking it at age 70, whatever age you want, they structure it so that you can see exactly what that payment would be. Now, doesn't mean you have to start taking it that year. It just means that they're lining that out front. Okay. I would point out here that annuities can be complex. So it's really important to weigh the pros and cons before diving in. There's different types. There's fixed index annuities, there's variable annuities, all different types. And, I work in that area and I'd be glad to discuss and show you how they can work. Or if you've got something set up and you want somebody to review it, I'd be glad to do that too. Okay. So the last one here, we're talking about dividends and interest, income from investments. So these are dividend paying bonds, stocks, other income generating investments that can help supplement your retirement and income. These provide regular payouts, but keep in mind that some of these investments come with risk, typically if they're in the market. So you'll want to strike a balance between income generation and protecting your capital. And keep in mind, we talked about in another episode recently in risk tolerance, that the closer you're getting to retirement, the lower that you want your risk to be. So even when we talk about these multiple income streams, if you're saying, I'm making my entire retirement, I'm betting on this particular stock and it's a dividend stock, I would say not a good idea. We don't want all our eggs in one basket. What we want, remember that conversation I had with the cardiologist that's building the big pile of money, which I'd sort of figured out he's going to run out in less than 10 years, but don't tell him because he's got a different advisor. Anyway, what I would say is that you're wanting income streams that will pay the bills, right? You're wanting that, call it teacher's pension. You're wanting that pension from whoever that's got a pension. Even government employees have pensions. That's covering the nut. And once we've got that covered, now we can look about other things that you may want to invest that could be higher risk. But I just want to make sure that you've got everything covered at home. You don't have to stress out about that. So we've talked a lot today about the retirement income gap. Do you know if you've got a gap or what it is? If you've been thinking about money retirement, or you're tired of thinking about it, or you don't know where you are, or maybe where to start, or even if you're looking for a second opinion because you've been working with somebody for a long time and you just don't know if the answers are true, just like a medical diagnosis, think about that. Medical diagnosis, somebody gives you a diagnosis and you go, I'm not sure if that's right. I'd like to trust it, but I want a second opinion, right? It's probably time for a quick calibration check on what you're doing. We can easily do that on a quick 15-minute triage call, and we can talk about it. So I recently did this for a call for a medical professional, and I found $7,000 a year without even getting into my process. So imagine that, $7,000 a year for the next 15 years, and he got that out of a 15-minute call with me. So that seems like a pretty great return, don't you think? So that's what I love about what I do. This is how we can get things moving and set you up for a great 2025 and beyond. So don't forget, mind the gap. Let's do this, and we'll see you soon.